If your business takes a lot of cash, the ATO has been thinking about you for years, and its tools have never been sharper. I am Benedict Yun, tax lawyer at Australian Tax Experts. In this presentation, we will look inside the ATO's cash economy playbook, the industry benchmarks that flag unusual returns, the third-party data it matches against what you declare, the indirect methods it uses to reconstruct income it cannot see, and a real case where a $900,000 assessment built on those methods was cut by more than 85%. Whether your records are immaculate or you know there is a problem, this is worth 10 minutes of your time. 4 numbers show what you are dealing with. 2028. The ATO's dedicated shadow economy compliance program, the successor to the old cash economy task force, has been funded through to the 30th of June, 2028. This focus is not going away. 300,000 plus, the number of tip-offs the ATO has received from the community since July 2019. Close to 1,000 arrive every week from former employees, competitors and customers. 100 plus, the number of industries covered by the ATO's small business benchmarks, the statistical ranges your return is tested against. And 85%, the reduction our office secured on a $900,000 cash economy assessment. We will unpack that story shortly.
Why the sustained attention? Because cash leaves no automatic trail, and the ATO knows that businesses dealing predominantly in cash have more opportunity, and sometimes more temptation, to leave income off the return. Hospitality, construction, and personal services sit at the top of the target list. Cafes and restaurants, trades and builders, hairdressers, beauty, cleaning, and similar services. And the program has been refreshed, not retired. What used to be called the Cash Economy Task Force is now the ATO's Shadow Economy Program, with dedicated funding locked in through to mid-2028. The shift to card payments has not ended the focus. It has simply given the ATO more data to test your numbers against.
The first screening tool is statistical, the ATO's small business benchmarks. These are financial ratios built from the tax returns of businesses across more than 100 industries. Cost of goods to sales, labour to sales, rent to sales, and gross profit margins, expressed as expected ranges for a business of your type, size, and location. Fall outside the range, and your return is flagged as potentially anomalous. Now, a flag is not an audit. Plenty of legitimate businesses sit outside benchmark for good reasons. But it raises your risk profile and invites a closer look. Take a cafe reporting a gross margin well below the benchmark for cafes in its category. To the ATO, that pattern looks exactly like unrecorded cash sales, and it will want to know why. The second tool is data, and the ATO holds far more of it than most business owners realize. Card and FPOS totals flow in from banks and payment processors, so the ATO already knows your electronic takings before it reads your return. Digital platforms now report directly under the sharing economy reporting regime. Ride sourcing and short-term accommodation since July 2023, and food delivery, tasking, and most other platform services since July 2024. The taxable payments reporting system captures contractor payments in building, cleaning, couriers, road freight, IT, and security. State registries supply property purchases, rental data, and vehicle registrations. And then there are the tip-offs, more than 300,000 since July 2019. If your card takings alone exceed your declared revenue, the inference writes itself. So how does an anomaly become a tax bill? It usually moves through 4 stages. First, the data flag, a benchmark outlier, a data matching gap, or a tip-off puts your business outside the expected range. Second, the risk review. ATO analysts test that anomaly against everything else they hold, your history, your industry, your associates. Third, the please explain, a letter or review asking you to reconcile the gap. This stage matters more than most people realize. Clear, documented answers can end the matter, while evasive ones accelerate it. And fourth, if the gap stays unresolved, a full audit, and where the records cannot support your declared figures, a reconstructed assessment. The earlier in that chain you engage properly, ideally with advice, the cheaper the outcome. Now to the sharpest tool in the kit, the indirect method. In a cash economy audit, the ATO often cannot see your cash sales directly, so it reconstructs them. The most common approach is the goods-based markup. The ATO starts with something it can verify: the cost of goods your business purchased, the coffee beans, the milk, the stock. It then applies a markup ratio drawn from industry norms to estimate the sales that stock should have produced. If the estimate comes out significantly higher than what you declared, the difference is treated as undeclared income and assessed with penalties and interest on top. Here is the critical weakness. The whole edifice rests on assumptions. Generic industry markups often do not fit real businesses, and that is exactly where these assessments are beaten.
Let me show you that weakness in action. A Sydney company operating 6 cafes was hit with a $900,000 tax bill built on the goods-based markup method. On paper, it looked formidable, an ATO assessment backed by industry statistics. But when our office examined the methodology, the flaw was clear. The markup assumptions were generic industry figures that did not reflect the company's actual cost structure, its pricing, its wastage, its product mix. We challenged the methodology, line by line, with the company's real numbers. The result? A settlement of $135,000, a reduction of more than 85%. The lesson is simple. An indirect assessment is an argument, not a verdict. Attack the assumptions, and the number moves. There is one more lens the ATO applies, and it is disarmingly simple. Does your lifestyle match your tax return? The question is whether your assets, spending and travel are consistent with the income you declare. The data to answer it is already in the ATO's hands: property ownership records, vehicle registrations, overseas travel movements, and bank account information. The classic red flag. A business owner declaring a modest income while holding multiple investment properties, driving a luxury vehicle, and taking regular overseas holidays. This approach is particularly effective where cash has been drawn out of a business without ever being declared, because the money has to surface somewhere, and when it surfaces as lifestyle, the ATO sees it. So what does protection look like? For a cash-intensive business, the best audit defense is boring: records. First, use a recognized accounting system and capture all income and expenditure as it happens, not reconstructed at year-end. Second, keep your point-of-sale records, till data, receipts and invoices in full. Third, reconcile cash daily. Match the cash in the drawer against the sales recorded and keep the workings, because those reconciliations are exactly what persuades an auditor your figures are real. And fourth, deal with the past honestly. If income has historically gone unreported, a voluntary disclosure, made before the ATO's data catches up with you, will almost always produce a better outcome than waiting. And the data, as we have seen, is catching up fast. At Australian Tax Experts, tax lawyers and accountants work on these matters as one team. We run audit risk reviews, benchmarking your business the way the ATO does, testing your ratios and your data trail, and finding the gaps before they do. We defend audits, scrutinizing the ATO's methodology and assumptions, as we did in the cafe case that went from $900,000 to $135,000. And we manage voluntary disclosures from start to finish, correcting past underreporting on the best available terms. If you run a cash-intensive business, the right time to understand your position is before the please explain letter arrives. If your business is in a cash-intensive sector and you are concerned about ATO audit risk, contact Australian Tax Experts for a confidential assessment
and strategic advice. Visit australiantaxexperts.com.au/contact. Thanks for watching. And remember, this presentation is general information only, not personal tax or legal advice.